There's another ticking time bomb in the financial system right now worth $1.7 trillion. And 99% of investors have no idea it exists. In the next 10 minutes, you're going to discover what private credit is and why the Bank of England just sounded the alarm and how this hidden risk could affect your portfolio. And you already know this video is going to be crazy. Stay tuned. Welcome back to StockScope Live. I'm your host, Ali, and today we're diving deep into one of the most alarming financial stories of 2025, the private credit crisis nobody's talking about. We've talked about slightly in our previous videos, but this isn't another doomsday prediction. This is based on actual bankruptcies, Federal Reserve warnings, and global central bank concerns. If you have money in retirement accounts, mutual funds, or pension plans, you need to understand what I'm about to share with you. Let's break this down. First, let's define private credit, because it's widely different from traditional bank lending. When you go to a bank for a loan, that loan is regulated, documented transparently, and it's subject to strict capital requirements. Private credit, that's where non-bank financial institutions lend money to companies, private equity firms, and other borrowers. It operates in the shadows of the financial system, with minimal regulation, zero transparency, and massive scale. The private credit industry just exploded from almost nothing a decade ago to $1.7 trillion today. To put that in perspective, that's larger than the entire GDP of most countries. This money is coming from pension funds, insurance companies, university endowments, and yes, your retirement accounts. Here's the scary part. While private equity-backed companies are failing, like First Brands, which filed for bankruptcy with over $10 billion in debt just last month, banks have been extending lines of credit to private credit funds. If those funds face stress, they can draw down those credit lines, and suddenly the banking system is exposed to losses nobody expected. Now, the Bank of England has a governor, Andrew Bailey, and he literally used the phrases, alarm bells are ringing about private credit, comparing it to the subprime debt crisis that nearly destroyed global financial systems back in 2008. And that's not a hyperbole. That's a direct quote from a central bank leader. So what are the warning signs that private credit could unwind? There are three major red flags. First, the loan quality is deteriorating. Private credit funds have been chasing returns in a low interest rate environment, and they've loosened lending standards dramatically. We've seen fraudulent loan documentation, inflated collateral valuations, and companies that shouldn't have received financing getting billions in funding. For example, First Brands, the company was owned by someone with a history of financial misdeeds and defaults, yet somehow it got over $10 billion in debt financing across multiple lenders. Second, opacity creates systemic risk. Nobody, and I mean nobody, fully understands the interconnections in the private credit market. Banks don't know their true exposure. Pension funds don't know what they really own. The Federal Reserve has estimated that even a moderate stress scenario could require $36 billion in emergency credit line drawdowns. That sounds manageable until you realize that that's just direct exposure. It doesn't account for the cascade effect when panic selling begins. Third, the maturity wall is coming. We're approaching a $2 trillion maturity wall in private credit and leveraged lending. Companies that borrowed aggressively when rates were low at the start of COVID will need to refinance at a much higher rate. Many won't be able to pay, leading to defaults and forced liquidations of illiquid assets. The Bank of England stress tests found something alarming. In a financial crisis, the connections that normally distribute risk smoothly become shock amplifiers. In other words, when private credit starts failing, the damage spreads to banks, pension funds, and regular investors faster than anybody expected. Here's what most investors don't realize. You probably already own private credit exposure through your retirement accounts. If you have a 401k or an IRA or money in index funds, there's a decent chance your money is invested in companies that depend on private credit financing. Major pension funds have been aggressively rotating money into private credit, looking for returns. The UK workplace pension providers are being encouraged by the government to invest $50 billion into private investments, including private credit. The US is following a similar pattern. When private credit unwinds, and history suggests it will eventually, pension funds will face two problems. Number one, the value of the private credit holdings will plummet. Second, the companies they've invested in could face funding crisis, leading to layoffs and business failure. The cascade effect looks like this. First, private credit fund defaults. That leads to corporate bankruptcies. That leads to pension fund losses. That leads to reduced retirement income, which leads to reduced consumer spending, which leads to recession risk. And finally, it leads to stock market decline. Each domino will fall faster than the last one. Now, here's the critical point. Banks are not sufficiently capitalized to absorb massive private credit defaults. The Federal Reserve's own analysis suggests that while the large banks could theoretically handle stress conditions, they haven't stress tested for a scenario where private credit and the broader economic weakness hit at the same time. And that's the blind spot that I'm afraid of. The time is particularly concerning because we're dealing with trade wars, rising tariffs, weakening employment data, and inflation still above the Fed's 2% target. Any one of those alone would be manageable. All of them hitting at once, combined with a private credit unwind, that's a recipe for a serious financial crisis. Now, what should you do with this information? Here are 3 actionable steps. Number 1, audit your portfolio. Contact your 401k administrator or financial advisor and ask specifically, what percentage of my account is exposed to private credit? You need to know this number. Many advisors don't even track this explicitly, so you might need to dig into fund holdings. Look for funds that invest in private equity, private credit, or alternative investments. Second, diversify away from concentration risk. The current market is heavily concentrated in the Magnificent 7 tech stocks and private credit. If you're overweight in either of these, that's a major risk. Consider diversifying into defensive sectors, utilities, consumer staples, healthcare, and international developed markets that are less dependent on tech and private credit. Third, make sure you build cash reserves. I know cash returns are low, but having 6 to 12 months of expenses in a high-yield savings account currently gives you optionality when opportunities emerge. If markets correct 20 to 30%, you want to dry powder to build quality assets at discounts. Finally, don't panic sell. Yes, private credit is risky. Yes, we could see market corrections. But panic selling at the wrong time destroys wealth. Instead, this is the time to rebalance, diversify, and position yourself to benefit from volatility rather than be destroyed by it. Here's what I want you to do right now. First, take 15 minutes of your day. Audit your portfolio using the steps I just outlined. Then, make sure you subscribe to this channel and turn on notifications, because we're going to be tracking this private credit story very closely as we have been over the last few months. This is not a one-time event. This is an unfolding story that's going to reshape the market performance in the next couple of years. And if you found this video valuable, drop a like and a comment. Tell me what you're most concerned about in your portfolio. Are you exposed to private credit? Are you taking action? Because I read every single comment and I reply as soon as I can. Thanks for watching, and I'll see you in the next video.